Last time on part 1 of episode 7, I covered one of the two forms of tax-advantaged accounts. I went over tax-deferred accounts, in which the taxes on income are deferred to a later date. This is delaying any taxes that are due on investment gains until your funds are eventually withdrawn. I explained two popular types of tax-deferred accounts, traditional 401k and traditional IRA. In this week's episode, part 2 of episode 7, we'll be going over the second form of tax-advantaged accounts, known as tax-exempt accounts. I'm Kevin Munoz. This is the Leo Podcast, and today is Monday, November 23rd. Tax-exempt accounts, on the other hand, provide future tax benefits because your withdrawals at retirement will not be subjected to taxes, unlike a traditional IRA and a 401k, where you are taxed when withdrawing money later in retirement. Hence why they are tax-deferred accounts. Keep in mind that since contributions into the account are made with after-tax dollars, there is no immediate tax advantage. The advantage of these types of accounts is that the investment returns grow tax-free. So the first account that I want to go over is a Roth IRA. It is an individual retirement account that allows qualified withdrawals on a tax-free basis, provided that certain conditions are satisfied. While Roth IRAs are similar to traditional IRAs, the main difference is, of course, how they are taxed. Roth IRAs are funded with after-tax dollars. These contributions are not tax deductible, but once you start to withdraw your funds, the money is tax-free. Traditional IRA deposits are generally made with pre-tax dollars, so you usually get a tax deduction on your contribution and pay income tax when you withdraw the money from the account during retirement. Let's go over an example of how this account works. Now, we're going to do some math here, so bear with me. I'll be sure to post it on my Instagram as well if you want to review it. Let's say you contribute $5,500 to a Roth IRA instead of a traditional. Rather than pay taxes on withdrawals 35 years down the road, contributing to a Roth IRA account allows us to get the taxes out of the way now. So consider this. You contribute the $5,500 as mentioned to a Roth IRA account that's taxed at 25%. Okay. So that would be $5,500 minus the 25% on the $5,500, which would give us $1,375. So your net after-tax contributions to the account would be equal to $4,125. Now let's say the account has an 8% return. So the value after 35 years at an 8% return would be $60,989.55, which is your net, aka what you'd be able to withdraw out of the account because you already paid taxes on it when you made the initial deposit of $5,500 35 years ago. So you can see how this account can be pretty beneficial. Now you might be asking yourself if there are any limitations on deposits. Well, again, like the traditional accounts, the IRS limits how much can be deposited in any type of IRA, adjusting amounts periodically. The contribution limits are the same for traditional and Roth IRAs. $6,000 is the maximum annual contribution an individual can make to a Roth IRA in 2020 and remains the same in 2021. Those who are 50 years old and up can contribute up to $7,000. Now let's go over the second type of account, a Roth 401k. Now, a Roth 401k is an employer-sponsored investment savings account that is funded with after-tax dollars up to the plan's contribution limit. This type of investment account is good for people who think they will be in a higher tax bracket in retirement than they are now because withdrawals will be tax-free. By contrast, the traditional 401k plan is funded with pre-tax money, which results in a tax on future withdrawals, which is why traditional is referred to as tax-deferred account. Think of a Roth 401k as a hybrid retirement savings vehicle that combines the best features of a traditional 401k and a Roth IRA. The contributions made by you, the employee, are made using after-tax dollars with no income limitations to prevent you from contributing. So let's go over an example of this. Suppose you earn $4,000 per month and have set aside 5% as a Roth 401k contribution. Then $200 is deducted from your salary each month after tax withholdings. This is opposed to a traditional 401k contribution, which is deducted from pre-tax dollars. So what are some of the benefits? Well, the benefits of a Roth 401k, as I've mentioned before, have the most impact on those who are currently in a low tax bracket who anticipate moving into a higher tax bracket in the future. Reasons for this being is because the contributions are taxed now at a lower tax rate, and distributions are tax-free when the individual is in a higher tax bracket. The younger you are, the more time for the account to grow tax-free before retirement, and thus to benefit more from the fact that distributions of not just contributions but also earnings are not taxed. So what are the differences between a Roth 401k versus a traditional 401k? Well, the main differences between a Roth 401k and a traditional 401k is the taxation of funding and distributions. When a traditional 401k is funded, the contribution is deducted from the employee's pre-tax income. Alternatively, contributions made to a Roth 401k are made after taxes are already taken out. A Roth 401k would be less beneficial if you expect to drop tax brackets, like someone who is already close to retirement who expects a drop in their income. So if you're a younger person and your employer offers you the option between a Roth 401k and a traditional one, it'd be wise to choose the Roth 401k if your salary is relatively low now, but it is likely to rise substantially over time. So what's the conclusion for all this? Well, no one can predict what tax rates will be decades from now. Neither type of 401k is a sure thing. For that reason, many financial advisors suggest that people hedge their bets putting some of their money into each one. Also, some open or convert to a Roth IRAs because they fear an increase in taxes in the future, and this account allows them to lock in the current tax rates on the balance of their conversions. Executives and other highly compensated employees who are able to contribute to a Roth retirement plan through their employers, like the Roth 401k, can also roll these plans into Roth IRAs with no tax consequence and then escape having to take mandatory minimum distributions when they turn 72. So in conclusion, since most retirement plans are tax deferred or otherwise tax advantaged, a discussion of the different types of retirement plans requires an understanding of that taxation, along with who establishes and uses each account, the rules of the plan, and ultimately, which type is best for you. And now let's do some finance facts. Did you know nationwide gambling rakes in more revenue than theme parks, sporting events, cruise ships, and music combined? In total, gambling accounts for roughly $35 billion each and every single year. Did you know all of the currency in the world, roughly 8% of it, is actual physical money? The other 92% of money only exists digitally, which makes a lot of sense considering how often people shop online by using a credit card. Over time, rats are said to have consumed nearly $10 billion of famed drug lord Pablo Escobar's cash. Apparently, he had so much extra money lying around his warehouses that he lost approximately $1 billion a year to the rodents. The largest counterfeit of US currency is North Korea. In fact, it's practically mastered the art of creating fake 50s and $100 bills, also known as super dollars. These bills are typically only able to be identified by machines at the Federal Reserve. Since 2009, they've collected roughly 45 million worth of counterfeits. Now some key takeaways. Tax-exempt accounts provide future tax benefits because your withdrawals at retirement will not be subjected to taxes, unlike a traditional IRA and 401k where you are taxed when withdrawing money later in retirement. Two types of tax-exempt accounts are Roth IRA, which is an individual retirement account that allows qualified withdrawals on a tax-free basis provided that certain conditions are satisfied. While Roth IRAs are similar to traditional IRAs, the main difference is of course how they are taxed. Roth IRAs are funded with after-tax dollars. The next one is Roth 401k. It is an employer-sponsored investment savings account that is funded with after-tax dollars up to the plan's contribution limit. Think of a Roth 401k as a hybrid retirement savings vehicle that combines the best features of a traditional 401k and a Roth IRA. The contributions made by you, the employee, are made using after-tax dollars with no income limitations to prevent you from contributing. And lastly, there are numerous tax-advantaged accounts. I only covered the most popular types of retirement accounts in this two-part episode. If any of the accounts I went over interest you, whether it's traditional or Roth, make sure to either seek a financial advisor, ask your employer for more info, or do your own thorough research so that you can start saving towards retirement with an option that best suits your needs. If you want to support me and the podcast, just follow my Instagram and any of my socials at Latin Americaneo. And as usual, if you have any questions or want to know more in detail about what was covered on today's episode, you could find more info in my blog posts on my website, latinamericaneo.org. That's LATINAMERICANEO.org. I'm Kevin Munoz. This is the Leo Podcast, and thank you for joining me today. I'll see you next time.